It's taking similar or same risk and then making a higher return.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, I got Juan Herrera and I've got Julio, and I'm going to butcher this. I asked you before, but I'm going to butcher it. So we got Julio Cacho. You say it the way you say it, because I don't have the linguistics down.
No problem. My name is Julio Cacho.
Cacho. There you
Cacho.
go. So, yeah, I knew I would butcher it. Well, welcome to the show, gentlemen. I appreciate you joining me. And you guys are both founding partners of Quantor Capital. And why don't one of you just give us a bit about your backgrounds, where you came from, and kind of what your focus is today.
Sure. Thanks for having us. So Julio and I started Quantor Capital in 2015 as a single family office. Previously, I was running a hedge fund for about 10 years. We sold that hedge fund in 2015. Previous to that, I was at Citi as a private banker. Went to the University of Texas in Austin. And then Julio and I have known each other for a while. And in 2015 started Quantor Capital to really manage the money of a few families here in Houston, which we're based in. And that company started to grow. We then opened the doors to other outside families and investors in 2017. And then last year, we also merged our advisory practice with a group of gentlemen that left UBS and formed Inscription Capital. And today, Inscription Capital has a little bit over $1 billion in assets under management. Quantor Capital manages a few investment strategies that Julio and I still run for clients. So that's still up and running, but it's more of an asset manager. And that's the brief background for myself. I'll kind of let Julio explain a little bit about his background.
Right. I mean, I'm just going to add that I also teach at Rice University, and I have a PhD in finance from Princeton University. And before meeting Juan Carlos, I was working for a private hedge fund in New York. And then the rest is what Juan Carlos basically said.
Awesome. And so Inscription Capital, that's your that's the main focus today. Is that right?
Yeah. So both firms do the same thing in different ways. So the way the industry works is that you have an investment consultant or you have a financial advisor that basically works with individuals, high net worth individuals, or institutional investors. You know, institutional investors are like pension funds or endowments or other financial advisors, to help them kind of figure out how best to allocate their money. What we do is we at Inscription Capital take a science-based approach to investing. What that means, I know science-based is a fancy word, but what that really means is that we look at all the empirical evidence, all the peer-reviewed journals that are out there, and basically translate those into optimal portfolios for clients. So there's two ways to really think about investing, right? You can either listen to financial gurus or analysts or forecasters that are abundant everywhere, right? On television, blogs, newspapers. The problem with that is if you step back for a second and you ask yourself, can people actually have a crystal ball and predict the future? It's kind of tough, right? I mean, not many people in 2019 when making their 2020 predictions said that, oh, we're going to be hit by a coronavirus and the whole world's going to almost come to an end.
Yeah.
But that's okay because predicting the future is practically impossible, right? There's too many variables that are involved here. And so then on the other side, you have, and by the way, if you do listen to someone that is saying XYZ is going to happen, right? The world's going to end tomorrow, or the stock market's going to go up forever, and you should do this or that. Always kind of ask yourself, if this person is actually yelling to us and screaming that XYZ is going to happen. Why is he telling everyone? Why wouldn't that person just be investing all his money into that if he's so certain that that's going to happen? Because if you're an investor and you're certain that something's going to happen, you're just going to want to probably do it yourself and hide it and not tell anyone about it, because it's a kind of it's a competitive game that we play in here in the investment world.
Yep.
And so on the other side, you have this whole, universe of academia that has really rigorous work that has been done in the past 50 years regarding investing, right? And analyzing all different types of ways people invest from every type of asset class. And there's countless papers that have been written on these theories. And very few people actually know about them because they're not easy to read. If you read these peer-reviewed academic journals, they've got all these formulas. It's not meant for the average person. So, but it is telling the truth, right? It is saying, here is the evidence. Here is what we see. And what I mean by empirical evidence is that it's actually proven, right? There's a way to prove it mathematically, right? What they're doing. And then it's taking that evidence and saying, okay, how can I apply that into practice, into the real world? And that's what we do, really. We try to help people kind of interpret that in a very simplistic way.
So yeah, you're just taking that data. You're not looking into the future in crystal ball. I mean, yeah, you're certainly trying to figure out where trends are going, I would imagine, but you're looking at the data that's currently available, and when you're assessing assets. And
yeah, I'll let Julio explain this, but this is basically Julio, maybe you can explain a little bit about the risk reward, but that's the core of the data. The data basically says that risk and reward are two sides of the same coin. And Julio, I mean, you can explain it better than I can, but why don't you explain that for us?
Yeah, I mean, I think the main findings are that it's extremely unlikely to find free lunch, right, in the financial markets. Mm-hmm. So because of this, really, the expected returns that you're hoping to receive in the future come from the amount of risk that you take. So your compensation comes from the amount of risk that you take. So if you want, for example, high expected returns, that means that you have to take a good amount of risk, because there is no free lunch. Now, in contrast, if you're someone that you are risk averse, extremely risk averse, you don't want to take any risk, then you should expect low returns, right? So that's kind of the main idea behind what people have found, or researchers have found in finance using data. And the facts, basically the facts, what tells us is that it's extremely unlikely to find free lunch. And we see this because people have run many tests in different different investors that try to outperform a market, for example. And what we see is that what empirical data tells us is that most of those investors are not going to outperform the market in the long run. Okay, so this is kind of evidence that is extremely difficult to find free lunch. Otherwise, you will have many people actually outperforming the market. So those are the facts, right? I mean, those are the facts, and based on those facts, we try to help people to form portfolios accordingly to the risk tolerance. And based on this, we form these portfolios that will target a certain level of risk, and they will give you some amount of expected return. So that's kind of the idea.
So you guys are dealing with mostly fairly wealthy people, funds. Is that correct?
We started off that way, but no longer. We actually, thanks to technology, we're now able to really help, people that they're just starting out saving money and investing, all the way up to, billionaires. So it's really a vast, the thing is that I think there's another misconception, and this is again, because of all the information out there and all the the way kind of the financial and the wealth management industry has been created, where there's a thinking out there that the more wealthy someone is, that the more they're going to have access to these unique investment deals, and they're going to always make more money. And the bottom line is actually there's a lot of evidence out there that's what ends up happening sometimes when people end up becoming more and more wealthy is they end up paying a lot more fees and in different types of investments, right? In like, limited partnerships or in real estate investments that carry higher fees with them. And there is no evidence that says that people with $1 million or more are going to outperform and make better investments than people underneath it, right? At the end, the formula that Julio is saying is understanding this very difficult concept that it is very unlikely for the vast majority of people, not just 50%, like I'm saying 70, 80, 90% of us, that in the long run, over a 20, 30, 40 year period, we're going to do better than if we just, invested in a very broadly diversified portfolio of, say, equities or bonds, depending on our risk tolerance, right? What kind of asset class, or real estate investment trusts, or so. I think people just fail to realize what their opportunity costs are when they are investing. All of us have this entrepreneurial spirit, I think, especially in the United States, where we always think that, we know the facts are, all of us kind of intuitively know that when we start a business, the likelihood of that business, succeeding over the long haul is very low. We know that about 70% of companies close their doors within the first 3 years, right? And we still do it because we have this kind of spirit in America, I think, of the entrepreneurial, which is, I think, one of the great virtues of the United States. The problem, though, is that it's not going to work out for most people, right? So for most people, they're going to try and take, whether they know it or not, absorb enormous risks, right? And those risks end up not paying out, right? And then they go bankrupt, or they end up. Now, if the ones who do end up becoming successful taking those risks are the stories that we hear about, the Jeff Bezos and the Bill Gates and everyone like that. And so it's kind of funny. It's like, I always say, look, if you want to become very wealthy, right? If wealth is something that is very important to you, monetarily wealth, right? You're going to have to go and work hard and do everything that people say that you need to do, right, to become wealthy. But look at it as like, it's kind of like buying the lottery, right? If you're going to win the lottery, you're going to have to buy the ticket, right? To be wealthy, the purchase of the lottery ticket is working hard and being disciplined, but that's not alone going to get you the wealth. There's a lot of luck in there too, right? That you're just going to have to, be okay with, understanding, right? Yep. And I think that's where we kind of help people realize that, to say, okay, look, the most important thing that you need to decide on as an investor, and we'll help you with that, and I think there's a lot of coaching involved with that, is figuring out that you clearly understand what are the risks that you're going to be taking, either in private investments with, you're starting a business, or investing in the stock market or the bond market or real estate. What are those risks? And do you understand clearly what those risks are? Right? Do you understand your worst case scenarios? Okay, then we can optimize portfolios for you, right? Because if you're someone who's willing to take a lot of risk, which a lot of people are, especially entrepreneurs who start their own businesses, they might want to learn that there's other ways to maybe compound wealth at a higher rate, right? You just have to be able to understand those risks too, right? And the biggest thing I think that especially entrepreneurs and people that are starting to create wealth miss is, in the private markets, you don't see this mark to market. You don't know what the value of things are. So psychologically, we kind of are okay with it. If we invest in a real estate project, or if we invest in a private company, right? We know how the company's doing, but there's no one buying it, right? There's no one offering a purchasing price for the whole company every single day. There's no one in the real estate market, right, bidding on a building every day. So you know what your yield is, you know what your cash flows are, but you don't know what it's worth. Right? You really don't know what it's worth. It's actually worth zero until someone makes a bid on it, right? In the public markets, we do see everything every day because we can see there are people buying and selling every day. But the problem with that is that psychologically, people start treating it more like a casino. And so it's like, oh, wait, this is going up. But at the end of the day, if you own equity, either in a private investment, in a private company, or in a public company, it's equity you own, right? It's a piece of that company. If you own a bond, or if you lent a company money, it's the same thing. So I think we try to help people come back to the realization that equity can be public or private. If you own a debt instrument, it could be public or private. If you own real estate, even it could be public or private, right? Again, what are you trying to do? And do you understand clearly what it is you're owning? And don't let the psychological, either, casino-esque mark to market of the public markets get in your way. And also don't be relaxed that just because you can't see the price of something every day doesn't mean that there's no volatility there.
Yeah, for sure. When you're you guys are looking at some of these different assets, and you can obviously put people into stocks and bonds, and do you have a lot of alternative assets that you can put people into as far as investing in private businesses, investing in real estate, like you talked about, things like that? Are you guys helping people navigate through that, or is it mostly into the public market?
No, look, at the end, alternative assets are just a different way that you end up using the basic assets, right? So like a hedge fund even, or a private equity investment is just a repackaging up of the traditional assets, right? Yep. So if you invest in stocks and bonds and that's it, and then you put in there a hedge fund or an alternative investment in real estate, alternative investments, I think are just a very fancy word to say they're actively managed. Most alternative investments are going to be very high in fees. And by the way, I'll let Julio explain this, but fees are probably the most important thing that people need to pay attention to in the long run. That's the main reason why people don't outperform in the long run. Sure. Because even if they do find a manager or someone that's doing XYZ and making a lot of money, their fees usually are higher, and they're the ones at the end keeping any alpha, and the investors are usually the ones underperforming the market. So it's great for the managers, not so great for the investors at the end of the day.
Sure.
And alternative investments end up having very, very high fees, especially because they charge a performance fee. So, a typical alternative investment in a hedge fund or private equity or real estate fund will charge probably anywhere from 1.5 to 2% in a management fee every year, no matter what happens. And then they'll charge you a promote of usually a performance fee of like at least 20%, right? And so those are very high fees. You don't have those fees really in the public markets, especially the performance side, right? Yep. And so when it's all said and done, it sounds nice. And I've heard this debate a lot when people say, well, performance fee is good because it aligns my interests with the client. Like if I'm a manager and I charge you only a performance fee, I'm saying, look, I make money if you make money. Yeah. But that's a lot that I'm giving you. I'm the investor and I'm taking all the risk, right? You're not putting any money up and you're the one taking 20% of the profits. Like that's a lot.
But isn't a company also taking a large chunk of the profits? Like let's say I invest in Walmart stock. They're making money, right? The fund manager is not making money, but Walmart's certainly making money.
So say that again. So with Walmart?
Well, like let's say I invest in Walmart stock, right? So let's compare Walmart stock to a real estate stock or fund, right? Private real estate fund. The general partner in the real estate fund is charging, let's call it 20%. They're going to be making that on that equity. That's because they're running that company, right? The piece of real estate. Well, in Walmart's case, they're making money as well. Now, the stock broker, whoever is, selling that stock to you, they're making their fee, but the company, Walmart, is making profit. So isn't that kind of similar, or maybe I'm disconnecting the two?
No, I think it's different. When you invest, when you are an investor, a direct investor on Walmart, mm-hmm. you own the cash flows of Walmart directly. So you have to pay the employees as an investor, but you receive without paying any fee the profits of the company, because you have claims on the profits of the company. Mm-hmm. What Juan Carlos is saying is that, so you have a company like Walmart, and on top of that, you have an intermediary that decides to invest in Walmart, but you have to pay that intermediary also. So it's different. So if you invest directly to Walmart, you don't have to pay to the intermediary, okay? So when you hire an active manager, you are investing in different companies, but on top of that, you are paying the person that is deciding in which companies to invest. So it's double. If you want to say it in terms of, if you think that paying employees, for example, in Walmart is paying a fee, you are actually paying double if you hire an active manager, because you're paying the fee.
But isn't your active manager kind of the CEO? Some of those, the top people, right? Where and the GP would be kind of the CEO, right?
So the GP will be the CEO of the intermediary that decides in which companies to invest.
Yeah.
So you are paying an extra fee there, right? I mean, you're paying a fee to that GP.
Yeah,
if you invest directly, then you don't pay that person, right? That GP.
But then you have to do the work, right? So if you invest directly in the real estate, you actually have to make the decisions day to day. You have to call the maintenance person. You have to call the person to go lease the property. You have to make all the decisions, where if I'm investing in Walmart, I'm not calling the employee going, hey, you're not doing a good job in aisle 3. Would you please, pick up the slack a little bit?
Right. But what I'm saying is, so let's not talk in terms of real estate for now. Let's talk just in different public companies, right? Just to make the analogy. So you can invest directly in different companies, right? Or you can hire someone to invest for you in these different companies. The only thing I'm saying is that if you invest directly in the companies, you avoid paying the fee to the person that is deciding in which companies to invest. Now, your question is, okay, but then you will have to decide which companies to invest on. Our philosophy is basically the best thing to do is to actually invest in all the companies accordingly to the market. Yep. That's the simplest research that you need to do. Just
so instead of paying somebody to make those decisions, just
buy them all.
Buy all.
Buy them all.
Exactly.
So like in real estate, to use your real estate example, right? Like here's where people need to, I think, make their analysis. Real estate has been a great asset class, right? It's been going up for now, since the financial crisis on a rocket ship, right?
Yeah.
And so what ends up happening with real estate is that people need to be aware, I think, of two main things. One is, what is your opportunity cost? Meaning, okay, is it worth it to pay a 2 and 20, these high fees to a privately held limited partnership that invests in multifamily or commercial real estate, right? Is it worth that fee? Or are you better off just investing in, say, a Vanguard REIT index, which is not going to cost you 2 and 20. It's going to cost you like 13 basis points.
Yep.
So it's very simple. You can just kind of look at a chart of the Vanguard REIT index and see what has it done the past 10 years. It's up like 300%, 350%. And so if your investments, all right, are taking similar risk, meaning if you're investing in almost over 100,000 properties, right, across the country, and you're making about the same, or if you're outperforming, if you're making more than that, then the net of fees, then it might be justified to pay the fees.
Yeah.
Sometimes people will say, well, I've made a little bit more investing in 5 or 6 projects. I'm like, well, yeah, if you invest in only 5 or 6 projects and the entire real estate market went up, right, and you made a little bit more than that over the same period, that's probably not outperforming. It's just that you're taking on more risk, and therefore you're being compensated for that risk. So it's just to understand why it is. We're not debating whether one is better than the other. We're just saying it's very important for investors to understand why it is that they're making money, right? Is it because of their skill, or is it because of the market going up and they're taking more risk than the market?
Well, yeah, it's that risk reward that you mentioned earlier.
Correct.
Certainly, could you make more on the hedge fund or the real estate private, yes, certainly. But you are, as you said, you're taking more risk. You're investing in 1 property, 5 properties versus hundreds and hundreds of properties.
But what ends up happening a lot is that a lot of times you'll be surprised how many people will say, well, man, I haven't made 350% in the past 10 years in real estate. I'm like, well, yeah, then you're not out. Then you're definitely losing on an opportunity cost of you're taking more risk and making less money.
Yeah.
So therefore, what we're trying to show people is that in that scenario, you're better off just investing in the whole market, not trying to, and especially if they're charging you high fees, right? For that. So that's kind of the analysis that I would like people to see, right? And then you have this whole argument, especially in real estate, going back to the private stuff, because that's where people will say, well, private real estate's less volatile. Like, no, it's not. It's just, there's just no one buying it, right? Yeah. There's just no one buying it. It's real estate. Again, it's getting cash flows from buildings.
Yeah.
And then lastly, I think people need to be aware of in real estate is the amount of leverage, right? That's always going to be a factor, right? So it goes back to the risk. If you invest in a portfolio of multifamily, units with one manager that uses 80% financing, and you have another manager that uses only 50% financing, but you say, hey, this guy that uses 80% financing gives me higher returns, I'm going to go with him. I'm like, yeah, he's giving you higher returns because he's taking more risk. He's having more debt.
Yeah.
Right. So it goes back to that analogy too.
Yeah. Yeah. There's definitely a lot to be looking at, especially as you're looking at some of these,
and that applies to all asset classes, real estate, equities, bonds, everything. Right. And so I think that's what we tried really to hit people understanding. And this is what the science says, right? This is what the academic literature kind of really enforces people to make sure that they're aware of this so that they can make better investment decisions.
Yeah. Yeah. Good points. What is a mistake? What's a mistake that you guys have made, and how have you learned from it?
Oh, I mean, I've made a lot of mistakes.
Oh, come on.
A lot of mistakes.
Well, yeah. What's one that maybe we can all learn from that you think would be beneficial?
Yeah, I'll start off by saying that I made the mistake that I truly believe that I could outperform the market, because I think we all believe that, right? If we all have this entrepreneurial spirit, which I have, right? It is a very humbling experience to realize, once you start really digging in and seeing how you can compare your returns to the market in a risk adjusted way, that you kind of start learning about, oh, wow, this is hard. And it makes sense, because investing is kind of like sitting at a poker table playing with everyone and you're competing, right? So if you think about it, right, investing is a zero sum game, in the sense that you have the market, which is the sum of all its participants, right? In any market, when I say the market, I mean any market, right? Mm-hmm. So any market that you're investing in, take the sum of everyone that's investing in that, right? And right down the middle of that sum, you have the market average, which is the market return, right? So that means that for every person that outperforms the market, there has to be someone that underperforms it by the exact same amount. That has to hold true, right? That's just pure math, right? So now you can see this game that we're playing, right? We're all competing against each other to outperform the market. And let's just say half of us do and half of us don't. The problem is that now that you add costs to the equation, that line right down the middle is no longer down the middle. It's going to move over where about, say, 40% of people outperform, 60% of the people underperform. So the majority will underperform just because you added this cost to the equation. Now, to repeat the exercise over and over and over again, what the academic evidence shows us too is that those 40% that outperform are not persistent. They're not the same ones in every observation over and over again.
So they're different people every time. Going back to average.
Exactly. So what happens is, as this plays out, those after 30 years that are left outperforming are like 3%, 4%. Yeah. And then the worst case is you don't know, and there's no way of knowing. You're going to have lucky people in there, kind of like the guy that flipped tails, 8 times out of 10, right? You're going to have lucky guys in there mixed in with skillful people. There's just no way of knowing how to disentangle the two, right? And I think that's the biggest mistake I made early on, which I did not know. You don't know what you don't know. And I think the more I started learning about all this, especially from Mr. PhD over here, Julio, that's I think one of the biggest lessons I learned. Julio, I don't know about you.
Yeah, awesome.
Yeah, definitely. I will say that my 2 biggest mistakes are sometimes overconfidence and sometimes the opposite, actually. So in terms of overconfidence, I mean, even that I did a PhD, right? I mean, I was involved in the scientific literature. I mean, after I finished my PhD, sometimes I actually doubt about science. So when I was working at this hedge fund, for example, I was like, oh, maybe it's possible to outperform. So I had these doubts, right? And sometimes even I thought that maybe I could be smarter than everybody else, and then I could outperform. But the thing is that there are so many smart people in the world, so many smart people, that it's extremely difficult to outperform. I think the problem is exactly that there are very clever and smart people. So that makes the markets extremely competitive and extremely difficult to outperform. So I think I lost some time while I was trying to figure out science versus anecdotes, and yeah, probably that was my losing some time there when I was doubting.
So if you can't outperform the market, then
we're not saying you
what's
can't
the
outperform
strategy?
We're not saying you can't outperform it. We're saying it's very unlikely.
Yeah. Well, so if it's a very unlikely, then what's the strategy? What makes, why not just randomly pick a bunch of stocks then?
No, randomly picking a bunch of stocks is trying to outperform the market, right? What we're saying is, now that you know this, we're not saying you can't make higher returns. So there's two different things here. Outperforming means that you're taking the same level of risk and making a higher return. Okay. If I invested in 5 stocks and last year, let's say I said I made 50% returns and the S&P made 15, I could say I outperformed. No, I didn't. I picked 5 stocks. I took on a lot more risk and made my return, right? I could have easily lost all my money too, because those 5 stocks I picked could have gone bankrupt, right? So outperforming, what we're saying is make sure that again, it's taking similar or same risk and then making a higher return, right? So what we're trying to make investors see is that you can make higher returns than the market. Yes. You just have to be aware that to do that, you have to take on more risk. And there's lots of ways to take on more risk more carefully than what we know how to do. Most of the time, people will take on more risk by concentrating more, right? By instead of picking 500 stocks or replicating the S&P 500, they'll pick 5 stocks, right? That's concentration, right? That's the way most people do it. There's a lot of literature out there that you can do it in different ways and still remain very diversified, right? You have factors, factors are, for example, you can use leverage, you can use a tilt to value, you can use a tilt to momentum, you can use a tilt to these certain kind of factors that a size effect, and these are going to be applied into multiple different things, where all these factors are increasing your risk profile, right? To give you an opportunity to make a higher return. Right. So there's a way that we can teach people to say, hey, look, if you want to make 15% returns, have you thought about looking at it this way? There's no free lunch, like Julio said. We're not saying that if we can try to help you make a return that's higher than the market, you're going to be outperforming. We're just saying, look, here's a way that you can try to look at risk in a different light and see it that way.
Got it. That makes a lot of sense. Well, good stuff, guys. I think we could keep on talking about this for a long time, which I would enjoy, but for the sake of the podcast, I do need to wrap up. So I want to ask you guys a couple last questions, and then we'll get how people can reach you. So what's a favorite book that each of you can recommend?
Julio, you want to go first on this one?
I have a few, so I can tell you. One that I recommend is Thinking Fast and Slow by Daniel Kahneman. Mm-hmm. I really like that one. Another that I like is Success and Luck by Robert Frank. I also like that one. Another that I can recommend is Fooled by Randomness by Nassim Taleb. So these books are kind of explaining the behavior of people, how they decide, help us to understand how we decide to invest, overconfidence, etc., etc. Because as we said, I mean, I think that the science is clear that it's better for people to replicate the market instead of outperforming. But these books that I'm recommending help you to understand why. Basically, that's the idea.
Awesome.
And then I would say A Random Walk Down Wall Street is it's a classic book. It's been around forever, ages. And it really talks about a lot of the theory behind it in a very simple way to understand and digest. And this book has been updated countless times in the past, say 15, 20 years. And then another one I would say is a new one that just came out called The Psychology of Money. The Psychology of Money just came out, and I think it's great for people to kind of also get an understanding of like Julio said, our behaviors, around investing. Behavioral, I think, is going to be the most important thing people need to realize or be aware of, because the formulas to investment to try to be a better investor are pretty straightforward. They're there. The biggest hard, even if you know the formula, the hardest thing to do is sticking with it and understanding why you're having a hard time sticking with it. And it's our behavior. And I think it's really important for people to understand that.
Yeah, absolutely. Absolutely. All right. So last question before we wrap up. I'll let each of you go on this one. What are your 3 pillars of wealth creation?
3 pillars of wealth creation is, number one, understand that it is very unlikely to outperform the market, just like you understand it's very unlikely to win the lottery. Doesn't mean it's impossible. It's just going to be very unlikely. Therefore, try to save and invest as early as possible in a very broadly diversified way, right? Where you're trying to replicate the markets as efficiently as possible, keeping your costs low. And, at the end, time is the most important factor we have for investing. I don't know if few people know this, but Warren Buffett was worth his, I think it's like 85 or 90% of his wealth was created after he was 50 years old. And that's because of compounding, right? And so at the end, compounding wealth is the way to go for most people. I think that's going to give you the highest probability of achieving a nice retirement, nice success. And understanding, really taking a deep dive, I think, into the basics of the science of investing, I think is really important, because it opens your eyes up to what the possibilities are.
Absolutely. Julio, you have anything?
I mean, I also think the same way as Juan Carlos. I will add also that for entrepreneurs, for example, or for risk tolerant people that want to have high expected returns, there is a way to do it, and a scientific way to do it, which is exactly what Juan Carlos was saying, which is, if you really want high expected returns, there's no other way than taking a good amount of risk. Now, what is key is what is the risk that you want to take, because you don't get compensated by taking any risk, right? I mean, for example, if you buy a lot, as Juan Carlos was saying, a lottery ticket, or if you go to a casino, you're taking risk, but your expected return is negative, actually. So you don't get compensated for any risk. The one that you get compensated for is systematic risk. Actually, it's basically the economic risk. No, for example, risks that affect all the assets at the same time, such as the stock market. So if you want high expected returns, you can do it. If you want to create wealth and you have patience and you are risk tolerant, you can do it basically doing 2 things: either using leverage, right, in a well-diversified portfolio, very well-diversified portfolio, and then you take leverage. That way you are taking more risk, but also you're expecting a higher return. Or you can concentrate in some part of the economy. For example, you can invest in all the small companies in the US. That way you're going to be well-diversified, you're taking more risk, but you're hopefully expecting higher expected returns. So yeah, I mean, the main point here, or we want to try to say, is diversify really well. Don't try to outperform the market, and focus on your risk tolerance. That's what is key.
Yeah. Good stuff. Good stuff. That seems like the overarching focus on what your risk tolerance is. And that's how you're going to get the returns that you're looking for if you take a scientific approach.
That's right.
Correct.
Yeah.
Correct.
Awesome. Well, gentlemen, I really appreciate it. Juan Carlos, Julio, thank you so much for spending time with us. How can our listeners get in touch with you and learn more about what you guys got going on?
So we have, I and another partner of ours at Inscription have a podcast going on too called Now Know This, where we talk about all these types of topics. We break them down into, 30-minute to hour episodes and try to explain to people, stuff about investments, economics, and behavior. Again, it's called Now Know This. I'm on LinkedIn, Juan Carlos Herrera. And Julio, you want to give I think you're on Twitter, your Twitter handle?
Yes, I am also on LinkedIn, Julio Cacho, and also I have a Twitter account. Also, you can look for me as Julio Cacho. I am in Twitter.
Great. We'll put that stuff on the show notes too, but appreciate you guys. Again, appreciate you joining us. Tons of great information. So thank you so much. And you guys have a fantastic rest of the day.
Thank you.
You too. Thank you so much for the invitation. Thank you.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.